Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Academy's weekly podcast. We'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and today's show is part of an ongoing webinar series that my team and I have been hosting, where we invite a rotating panel of manufactured housing industry experts to discuss the state of our industry as it relates to not just the corona pandemic, but also the general outlook of the manufactured housing industry and how you can not only survive, but ultimately thrive no matter what the current state of affairs are in our country. And in this particular town hall webinar, we are joined by Don Vedeen, who is a top broker with Northmarq Manufactured Housing Division, and also by Jeff Moss, who is the Director of Loan Originations for Bond Street Capital. And so, guys, I'm super excited to get on to the show, but before we do, I have a few quick housekeeping items I want to run through. And the first one here is just to remind you how to get signed up for next week's webinar. Okay, this is going to be the 5th town hall webinar, where we've got some awesome experts that are going to be sharing some great information. To get registered for that webinar, just go to the link in the show notes and you can get signed up there. Moving on here, I just want to remind you of the free gift that we offer to all listeners who take the time to leave a 5-star rating and review on iTunes. And what we'll give you is the exact cold call script that we use in our very own business. And we purchased about half of our portfolio from our cold calling efforts. And so if you're serious about getting started in this business or taking your existing business to the next level, then you need to be cold calling park owners directly. And this script will help put you on your path to success. So to redeem this free gift, simply send an email to gift@mobilehomeparkacademy.com. This tell us who you are and what screen name you use to leave the review, and we'll go ahead and get that sent out to you. And lastly, guys, one last thing here to make mention of before we get rolling with this week's webinar is we just launched a brand new partnership program called Bring Kevin a Deal. And this is where I will pay you as much as $200,000. Yes, you heard that correctly. $200,000 for any deal that is referred to me that I end up buying. Okay. To learn more about this opportunity and to also download my deal acquisition criteria guide, you can simply go to bringkevinadeal.com. Again, that's bringkevinadeal.com. I'd love to put a big fat finder's fee check right in your hand, and I'd also love the opportunity to work together with you. So again, go to bringkevinadeal.com to learn more about that partnership program and also to download our deal acquisition criteria guide. All right, guys, so that's all I have here. So without further ado, let's get on to the show.
All right. Hello, fellow investors, and welcome to another Mobile Home Park Town Hall. Thank you all for joining us. I'm your host, Brian Spear, along with my co-host and business partner, Kevin Bupp. Kev, how you doing today, bud?
I'm doing awesome, man. Sun is shining, and I'm here with you guys, so life is good.
Yeah, no complaints, right? Joining Kevin and myself are a couple of great guests today to provide some answers to your questions and give you an update on the current trends in the mobile home park industry. With that, we'll jump right into it. I'd like to start with a brief introduction from our guest panelists, Jeff Moss and Don Vedeen. Jeff's a mortgage broker in the space, been doing this for years and years, and Don is a broker out of the Phoenix area. So if you guys could each give us a minute or two on yourself, we'll then head right into questions from the audience. But I'll pass the mic first to Jeff, if you'd be so kind. Go ahead, bud.
Thanks, Brian, Kevin, and Don for having me. Super grateful for the opportunity and always happy to talk about the space. I've jumped into the mobile home park arena and the commercial real estate market in 2003. And really, Bond Street Capital is a full-service mortgage shop, and we lend on all property types. And in 2008, 2009, I gravitated towards the mobile home park space and have been pretty involved in that space ever since. And it's been a little bit of a roller coaster ride, but for the most part, the space has been as strong as any other space that we've seen for the last decade. I think it's just really gaining traction now. But so 80% mobile home park community is bulk of my business. We do some multifamily lending as well. Just excited to see the space grow as it has and be a part of it.
Great stuff. Thanks for a little brief background there, Jeff. Pass the mic to Don. If you can give us a couple of minutes, it'd be great, buddy.
Yeah, absolutely. Thank you guys again for having us on, and always nice to talk shop about parks. Didn't, long story short, didn't know I was going to be a mobile home park guy when I got into my professional career, but I don't know if we all thought that, but here we are. But a little bit about me and Northmarq. If you don't know, Northmarq's the largest private company that's direct to Fannie and Freddie. So we do have a very large loan business. I'm on the investment sales side. I don't do any loans personally, but we're a national group. We're based out of Phoenix. I've got two business partners, Jared and Chris. We just, focus on parks all over the country, no specific market. Obviously, local to Arizona is easier for us to get around to, but focus everywhere. And I think the biggest thing about us is two things really. We're listing guys. We market all of our properties. So all of you looking to get, information on deals that we have, I'm sure we'll give our information at the end of the webinar here, but just reach out. You'll get on our list. And as soon as we get a deal, it goes to everybody. So there's no, hidden deals that we have. And the other thing is we're here for information. Anything we can help provide you guys watching this. If you're looking for our market reports, our sales reports, we'll talk about that later. Again, reach out. We'll get you on our list. We want you guys to have as much information as possible.
Yeah, I love that. Little follow-up question for each of you guys. Start with Jeff there. What kind of loans are typically right down the fairway for you? Size, scope, the class of deal, et cetera. What's right down the fairway for you?
Yeah, that's, we don't see a lot of right down the fairway deals for the most part, but, right down the middle of the fairway would be a deal, 150 spaces, 85% occupancy, 25% park-owned homes or less, minimal deferred maintenance, a sponsor that has experience certainly helps, us go a long ways with that. But I think for what most of the business we see, it has a lot of value add component. So the middle of the fairway, the deals that we like to see, the deals that we can place agency debt on, are always a little bit easier. But most of the stuff that we see has a little bit of hair on it. And, that's kind of where we shine is we've got the banks, the credit unions, the agency debt, and the CMBS markets are now starting to come back. But middle of the plate, it's really all over the place for us. So we don't see everything right down the middle. I would say it's a lot of balls and strikes.
Fair enough.
And some foul balls as well.
I hear you. No worries, man. Such is life in the mobile home park industry, right? A mobile home park is a mobile home park, but a 1-star versus a 5-star is a completely different business. So I hear you.
Yeah, and I will, real quick, Brian, I will say that, we worked with Jeff now for a couple of years, and right down the fairway, right? That's a perfect world, and we don't live in a perfect world. And I know you've gone to bat for us on a number of different deals that were far out of the fairway, right? Like they were a hook, if you know what I mean. And you found a home for them. You found multiple different options for a home. So, we've always had great experiences with you going to bat. And so I want to make sure that everyone's aware you're not just an agency guy, but you'll work to place any type of debt out there, and you've done a great job doing so with us over the last couple of years. So, yeah,
all good stuff. And passing the mic back to Don. Typical deals coming through your pipeline, right? I know you're based there in Phoenix, and you'd mentioned you guys are all over the country, and we'll source deals in that manner. But what is the typical type of deal that comes through for you?
Typical. I don't know if that exists. You guys, come on. What's a typical acquisition, right? It's not. I could tell you what everybody thinks is typical is what everybody talks about, right? 100 size, city utility. I don't need to get into that. But a typical deal is it's got hair. There's something on it that is making it not as attractive. I think that's the biggest, thing that we have to overcome as brokers when we're, talking to a seller about the value of their property, being realistic and looking at, sure, there's upside in the deal if you completely redo the streets or if you add a pool, whatever it is, but it's just some like thing out there that they haven't done. And so, I think the typical deal is a deal that is just, it's got hair on it, and you gotta get creative and you gotta figure out how to do it because sure, I would love to get those, 100 plus 200, 300 site parks, perfect MSA, 99% occupied. See, like, that'd be great if that was my typical deal, but you don't even have to sell that. I mean, everybody's going to buy that, no question. But yeah, I would say typically for us, we're looking at, infrastructure issues, whether there's something, the electricity is not high enough for certain types of units, the site count or the site size is too small. You can't get in the modern homes. I'd say that's pretty typical. Old homes, park-owned homes, those are probably the most common things that we see.
Yeah, good stuff. And truly, that's actually the benefit of this business, right? Some of those broken pieces are what make this industry such an appealing industry in terms of the rate of return you can garner during the hold period of the asset, right? That's why they call it sweat equity. So in any event, we'll move on. Very much appreciated, guys. What I'd love to do now is just go ahead and share my screen. Jeff was kind enough to prepare for us a term sheet on the current debt that is available in the marketplace. So with that, I'll go ahead and pull up kind of the most recent rates as of, I believe, Monday of this week. So
they haven't changed much.
Yep. Go ahead, buddy. Can you guys see that?
Yep.
All right, go ahead. Jeff, if you could just kind of walk us through where we're at here, it would be great.
Sure. So this pricing matrix is for loans from $1.5 to $6 million on the MHC side, 80%, 65%, and 55% loan to value. You've got two different programs here. You've got one that has yield maintenance, which is the prepayment penalty. And then you've got another one below that has a declining prepayment schedule. You can see that rates are really at historic lows right now. If you look at a 10-year MHC yield maintenance deal, you're at 3.3% on an 80% loan to value deal. That's not, there's some reserves on that, 12 months P&I, but I would focus probably, let's look at the 65% LTV on the 10-year, 3.15%. You're not going to be looking for any, really too many waivers there. You do need, this is a agency deal, so 85% occupancy, 35% max park-owned homes with a plan to convert some of those from a lease to own. Rates are historically low, and then if you get down into the lower leverage deals at 55% or lower, you're seeing rates in the 2% right now.
Yeah.
And this is on a $1 to $6 million loan. If loan amounts over $6 million, you can knock off 30 basis points from the rate. So you're seeing rates, if you look at, we'll go right across the board at 55% loan to value, 6 million and up, you're at 265 on a 10-year fixed with a 30-year AM, and you can also get some interest only on that. So at 65% LTV, you're at 285 on a deal over 6 million, and at 75 to 80% max. That's always a stretch to get there, but you're at 3% on deals over 6 mil.
Yeah, it is amazing. It's amazing the type of debt that you can get today. And when you look at this term sheet compared to kind of where we were a couple of weeks ago, you're not going to see a huge difference, but the market is still extremely volatile. Before we go into kind of the Fed funds meeting and kind of where we're at and where we're going, I'd also love to take this term sheet and compare it to what you have seen come across the desk in terms of multifamily as well. So for reference, you also do some multifamily stuff, have some relationships on that front. And I would love to just compare the multifamily rates to that of the manufactured housing sector. One of the things that I've found to be just unbelievably attractive is that the MHC stuff is now beneath that of the multifamily sector, which is unbelievably phenomenal. It conveys to me that the banks believe that manufactured housing is a better bet over the long term than multifamily, and that's a significant shift I feel that has occurred over the last year for folks in this space.
Absolutely. Thanks, Brian, for that. Let me just jump in on that. On the agency side, Fannie has a mission to duty, and a lot of that thought process is we need to serve the affordable housing community. And with that being said, your affordable housing is, in their mind, some of the, if not the safest investment in the marketplace. You've got low rents. You've got, people that own their own homes, particularly on the agency side. If you're at 85% occupancy with a low leverage of a percentage of apartment homes, you've got tenants owning their own homes. You've got affordable rents, which means a very low default rate, which equates to low rates.
Yeah.
And they're very, very comfortable in that space. And we don't see that changing anytime soon. And just from a basis point standpoint, from multifamily to mobile home park side, mobile home parks are being priced about 30 basis points below the multifamily pricing matrix, and which you haven't seen in up until recent times. Yeah. Which bodes really, really well for the space.
I agree. It is phenomenal. Just for an apples to apples comparison here, guys, for those that are listening on audio, for the benefit of them, I'm looking at the multifamily rates on a 30-year fixed 10-year term note, 3.51% on the multifamily side for loans that are $1.5 million to $6 million bucks. And then when we head over to the manufactured housing side, same exact 30-year, 10-year term, 65% LTV. It's at 3.15%. So just
substantial.
Yeah, it is. It's nice to see. In any event, feel like we're getting in the weeds a little bit, guys. Let's get out of here. I'll stop sharing my screen, and we'll talk about kind of how the industry has played out, and what we may see in the future. As mentioned a couple of minutes ago here, the Fed funds rate guidance was provided during the middle of last week. They shared the dot plot on what they're going to do or what is likely to occur with the Fed funds rate through the end of 2022. And it's very likely that it's going to stay at or near zero for 2.5 years. Clearly interest rates have plummeted since they've made that decision a couple of months ago. And now that they've provided guidance that they will likely keep these rates exceedingly low for the next 2.5 years, would love some thoughts from both of you guys on how that decision is going to impact mobile home parks over the short to medium term. Would love to pass the ball to Don to get some feedback on how cap rates might be affected by that sort of Fed funds decision there.
Yeah, no, I mean, great question. I think it's just going to encourage more aggressive pricing, more aggressive acquisitions, because, you're not going to get it, like you were, from the rates and things, from the Fed. But it's just what we're seeing is the people that already believed in manufactured housing, I think they're going to use this to get more aggressive and continue purchasing and continue compressing cap rates. We just had this, big pandemic, and the industry's doing fine so far compared to other asset classes. So, I guess why wouldn't you continue to invest and get it before it goes down even further, right? I mean, we saw it in multifamily. I mean, 10 years ago, apartment cap rates were insane, in a good way, much higher than they are now. And now you look at an A-class apartment building and the cap rate just blows your mind. The exact same things happen with manufactured housing. We've been talking about, recession resistant for a long time. And, the proof is there. And, I think it's just going to encourage the people that already trust the asset class to just keep, going full steam ahead.
Agreed. Any additional thoughts there? Jeff, thoughts on what might occur over the next few years, given some of the guidance that we saw there?
Yeah, thanks, Brian. I mean, we see rates staying low for at least through the next couple of years. I think with the pandemic, I think the Fed's trying to keep everything in check. I think we're trying to keep the economy in check, and we don't see rates, fortunately, we see rates staying low for several years. Not really moving too much from where they're at right now. I mean, what you are seeing is, again, on the agency side, you're seeing a pretty big drop, but on banks and CMBS and even credit unions, if you were to look at interest rates, 6 months ago, for example, on a CMBS deal, it's priced lower than what it is today. So they've widened their spreads. Banks and credit unions are about the same. So they've actually widened out their spreads a little bit. Even though the treasuries are down, they have kind of compensated by widening out their margins. So you're benefiting from the lower rates on the agency side, but it's still pretty much a wash on credit unions, CMBS, and banks. They're not priced too much different than they were before COVID.
Hey, Brian. Yeah, before we get moving on here, I think would be helpful for those that are listening, especially those that maybe haven't gone down the agency road yet as far as getting debt on a mobile home park is, we asked Jeff what the deal right down the fairway looked like, right? And that's more speaking to a property that's akin to Fannie or Freddie type debt. And we asked Don the same thing. And, there's not many deals that fall right down the fairway, right? A lot of them are value add and fall outside of those initial parameters that would be Fannie or Freddie right from the get-go. And so I think it'd be helpful to clarify for those that are listening as to what exactly a deal looks like. So we're looking at these rate sheets and these term sheets. What deal today, or what is Fannie and Freddie looking for today in order to consider putting some debt on a mobile home park? What criteria or parameters does it have to fall within? So Jeff, maybe I throw it your way as far as total number of park-owned homes that it can have, total economic occupancy, what they're looking for in the MSA. Are the utilities, private versus public, is that a consideration? Just all the different variables that are involved. And I know there's exceptions as well, but just generally speaking, maybe if you could share some details there.
Sure. So, I mean, broad strokes, you're looking at 50 pad minimum. Mm-hmm. Loan amount, $1.5 million and up. Loan amounts seem to be rising with most of the capital sources, but they'll look at deals at $1 million and up, but for the most part, $1.5 million and up. 25% park-owned homes is kind of their threshold. 85% occupancy, is what they're looking to see. They'll go into tertiary markets, so that's one thing that they will do. Deferred maintenance is normally a problem for them if there's, they like to see paved roads, paved parking spaces, if that's common for the market. If it's not, then you can have an exception made there. LTV, 65% is where they're really comfortable. We can get it up to 75, but, the park really has to be a clean park. That's, their city shore water's a plus, but while it's septic, we can always, have an exception made there.
Is there ever exceptions made? Let's say that it's a park that's got gravel roads, really clean park, equal mix of double wides and single wides, great market. I mean, just clean park overall. It just happens to have gravel roads. I've seen a few like that.
You can't. Yeah, I mean, if that's common for the marketplace, yes.
Yeah.
And if it's not, they'll hold back a reserve
to do the paving
for the CapEx, paving the roads or whatever. Whatever comes out of the PCA, Property Condition Assessment Report.
Yep.
And then you're going to have to pave the roads if it's a requirement. But certainly they can make an exception if it's commonplace. If parks in the surrounding area have gravel roads.
Yeah, got it. Well, worst case, you still hold back reserves and just do the paving after the closing. So either way, they would make that a consideration.
Yeah.
Got it.
And once you kind of get below that 85% occupancy, or now you're at 60% occupancy, and you got a value add deal, Fannie's a no go. So now you start almost after once you get to below 85%, you start looking for other lenders. So from a borrower's perspective, you've got a park at 70% occupancy. And you're thinking, well, I'm going to get a Fannie Mae loan on this deal at 2.9%, 65% LTV. It's not going to happen. So that's kind of where we come into play and get the borrower's expectations in line and able to find capital sources that we can actually get the deal done.
Mm-hmm.
Good stuff, guys. Good stuff. Heading on to the next question here. This one's really for Don. Are transactions increasing as the economy reopens? Now, some of these MSAs, the folks are starting to move a little bit more. Have you seen more transactions as a result?
Absolutely. I think when everything hit, there's probably, 4 to 6 weeks, 4 to 8 weeks of just slowing down. And it's not a factor of just people being scared of manufactured housing communities as an asset class. I think it was more of just a technicality. I mean, debt was questionable. People didn't know what was going on in the capital market. So when you're underwriting a property for an acquisition and you don't know if you can get that loan, or the banks are telling you they don't even know if they're going to loan anything, just naturally they're going to just hang tight. And the other one, which is interesting, was just not being able to go to the park. I mean, not wanting to fly. I think we have a client that went and rented an RV and went to like 30 parks or something. So if you're not willing to do that, everybody was just kind of grounded unless you were looking local. But since things started opening up and, we've got some debt back in the picture. Honestly, we had a couple deals that were listed that, quite honestly, I thought it was dead. And like immediately people started calling. We put a bunch of deals under contract in just the last couple of weeks. At great pricing. It was just a factor of buyers, trying to take advantage, not take advantage, but, seeing an opportunity to get a discount and trying to rationalize it with the COVID, and sellers just not willing to, provide that discount. They're the most optimistic people at the time, saying, oh, this is going to blow over. So there was just a kind of a standstill where the pricing wasn't meeting. People, saying we're going to have to pay all cash because we can't get a CMBS loan or whatever. But as that's kind of wearing off, yes, we have seen a huge influx of people, calling us, asking for opinion on value, considering the current market. Am I still going to get top dollar for this park? And then, obviously just, we always have buyers calling regardless. That doesn't change. That gets more no matter what. Just as the days go by, there's more buyers in the marketplace for mobile home parks. But yes, in general, I think big positive outlook. And I think another thing to notice, people from other asset classes just, I'd say cat's been out of the bag for how long? We've been saying that for years. But now it's like we hit a whole nother level of people that were so stuck on, retail or something where they never would have considered a mobile home park, are now calling us and saying, we got to diversify, like, tell me more about mobile home parks. And so it's, there's a lot of activity in the market right now.
Yeah. Yeah. The macroeconomics certainly speak for themselves. And as more institutional data comes out, more and more and more buyers will come. And to your point earlier, we may see lower cap rates as a result, not only due to the lower interest rates that are available, but also due to the additional buyers in the marketplace. So time will tell. I mean, nobody has a perfect crystal ball, but that's where things have been trending and will likely continue to trend for the short term here, short to medium term. On to the next question. When it comes to the size of a community, is buying bigger better? Typically speaking, is a bigger community a better investment when you're looking at the size of a community?
It's tough. It depends on the buyer. It depends on where their capital is coming. If they're syndicating, what are their terms on their deal? With the equity. But for me, I'm a math guy. I absolutely hate, like in school, English and history and stuff like that, but love math, love science. So math just makes sense to me. I mean, if you just take a 200 site park and a 50 site park and do a $20 rent raise, right? I mean, you're going to get a significantly higher, for the exact same thing on a larger park, right? The same $20 rent raise. You could have the parks right next to each other, same market. You get more bang for your buck on a larger park. When you're, let's say you're acquiring a 50 site park and a 200 site park, and you got to hire a new manager, and you're going to go through the same process, but you're going to get more return out of it on a larger park. So in that respect, just dumbing it down to math, absolutely. But you also have to think, what's your situation? Is this your first park? I wouldn't, grind yourself trying to find this, imaginary unicorn 150 site 10 cap on city utilities, because you're not going to find. I mean, if you find it, God bless you. Like, that's amazing. I make calls all day, and I don't find sellers that consider their park a 10 cap at that point. But if you could find it, great. But I think when you're starting out, getting those smaller parks or finding smaller parks in a similar metro. I mean, I've got clients that live out here on the West Coast and have just clicked in the Midwest, and they're finding these smaller deals. I mean, I talked to him. He was potentially going to sell a couple of parks. They're a few miles away, and they're 20, 30, 40 site parks. But every time we get talking about selling, he gets another park under contract, another like 30 sider. So by the end of the day, he's going to have like 400 or 500 sites over all these little, smaller parks. And I think that's okay too. And he's getting good deals on those 40 site, 50 site parks that you wouldn't get on a 100 or 200 site park. So if you're new to the game, I would just stay out of that. I mean, keep looking. I don't want to, crush anyone's dreams here, because you may find it. I don't believe, it is possible. But I would focus personally on something a little bit smaller, build a little bit of a portfolio, and then sell it, and then try to get competitive with those bigger deals, or refinance as well. But I mean, I think if you have the means to do it, the bigger is better. But it's not the only thing out there.
Yeah, great stuff. And to the point about aggregating small parks and turning them into a modest-sized portfolio in a specific MSA, when you do that, you can generally get a better multiple on every dollar that you drop to the bottom line, right? I mean, if you have 500 spaces in a given MSA, it's likely that the cap rate on that portfolio of parks will likely be lower than that of a 50-space park in that same MSA. That kind of same logic follows to the most recent transaction that kind of shook the headlines in the space a week and a half ago, where the same sort of thing occurred. And it's kind of right in Don's backyard over in Mesa, Arizona. For those unaware, Carlyle Group just came in and bought 4 mobile home parks, only 4 mobile home parks, for a combined $230 million over there in Mesa. That's about $145,000 per pad. And while I don't know the exact financials of that portfolio, it's obviously follows that that's a very, very low cap rate. And the question, guys, is that a good transaction, right? Is that a good buy from Carlisle's perspective? Would love to hear some thoughts, Don.
Yeah, so I would say 100%. I mean, just like I was just talking about, it just depends on where your money's coming from. And being a math guy, again, it's just look at the numbers on it, right? It's 1,600 sites. Let's just imagine it's a 2.5 cap, right? Like something crazy. You got to realize their money is much cheaper than what I would get, if we were going to go syndicate a deal. You got to pay your investors an 8 pref and then an 80-20 split or something like that on top. I mean, they're nowhere near that. I mean, they're probably, 2%. So, I mean, 1.5, I don't know, it's low. Their cost of capital is way lower than you're going to get syndicating a deal. So a 2.5 cap to us is like, I'm just bleeding money. I'm never going to make anything. But to them, if they're profiting, whatever, 0.5% or 1%, I mean, it ends up being a significant amount of money. Then you add the fact that, again, it's in, a super stable market for manufactured housing. It's all 55 plus. It's that, that unicorn deal that we're talking about. It's a pretty stable asset in their ultimate, portfolio of everything. And, a little rent raise goes pretty far to just constantly bump that cap rate to, I mean, it's still not going to be reasonable for you and I, our syndications, but yeah, I mean, I think for them, it's a steal for them to get that many sites in this market, because that's exactly what they're looking for. So they're willing to pay for it.
Yeah. And I would just say, obviously, it depends on the business model, what they intend to do with that asset, if they intend to flip it or hold it over the long term. I'm a huge proponent of the long-term same-store NOI growth in this space. I mean, the statistics play out that over the long term, it's very likely that the NOI of this asset class will grow at a higher rate than that of a lot of other asset classes in the space. So, the merits of that acquisition might not show immediately. It might not show in 6 months or a year, but depending upon what their duration of the hold period is, right? 10 years down the road, if they're raising rents at a clip significantly higher than that of core inflation, which, what we just talked about with the Fed funds rate sitting at 0, inflation's not even near their 2% expected rate or kind of target rate. They're still going to be able to raise rents in that portfolio, undoubtedly. So time will tell. I mean, nobody knows. Right. I guess if it's a good buy until we, have some years down the road and we can see some data. But it'll be interesting to watch and see how that shakes out. It's just a great example for folks to realize the type of money that's coming into the space. I mean, we've had a lot of massive institutional players that have come in over the last few years. To really drive down the cap rates, as we've discussed on many, many occasions. But that is a real example of that playing out in today's market.
Yeah, real quick, Brian, before we go on there, Don, you're obviously familiar with the Mesa marketplace. What is the the going lot rent for a 55 plus community such as one of these 4? What's the market rents?
500 plus.
Okay.
Just depending on the quality and the amenities and so on. But it's 5 to 550.
Okay, got it. That's all.
Yeah, good stuff. Question from Eric here. Where do you source mobile home renovation materials? This is an operator question. I'll cover this one. We've got a few different things that we do personally. We have commercial lines of credit at both Home Depot and Lowe's for those materials where you just need to literally run out and fix something immediately. Now, they don't have all of the mobile home specific stuff, right? A mobile home door, you can't just go pick up from Home Depot. So if you need mobile home specific stuff, you can go to a few different players in the industry. We rely on Purchasing Platform. Blevins is another one. Stylecrest is another mobile home specific manufacturer that you can reach out to and develop a relationship with to get some pretty reasonable deals. But that's how we source our mobile home renovation materials. Next question here. Do investors expect the demand for affordable housing to increase over the next 6 to 12 or 18 months? And is the tenant base going to change given the crazy chaos associated with COVID? Do you see any material massive changes occurring over the next, year and a half?
I'll jump in there on that. Not really. I think you're going to see more people moving into mobile home parks because of the economics of it. I think that's why it's so attractive. People there's a lot more unemployed people out there today, and people are looking for affordable housing, and to own your own home and to be paying under $1,000 in rent is hard to come by. And a lot of these parks are, with the amenities that they have and proper upkeep, it's like having your own affordable home for under what you would pay for an apartment building or an apartment. So I think you're going to see more people gravitate towards the space, and I think that's why the lenders are so attracted by the space. And I just wanted to kind of jump back to is bigger better than smaller, or what do you reference there, and what do you prefer? The borrowers really have to understand, as Don had mentioned, they got to manage their risk, and they have to understand their expectations going in. I mean, at the end of the day, you got to figure you're going to need about 30% down to go into a deal. So if you're a first-time buyer and you're thinking, well, I can get a great deal on, rates are low on a $6 million deal in that park. Listen, you're going to have $1 million in equity to go into the deal, right? So managing expectations goes a long ways as to what type of park you're going to be able to get into. But at the end of the day, for the new buyers out there, the people that are relatively new to the space, understand that you're going to have some skin in the game. Typically, it's going to be 30 to 35% down with some closing costs. So you have to really look at how much equity you have in the bank, and then go from there and determine what size park you can buy, right? I mean, if you've got unlimited sources and you have a fund, then you can look at the bigger parks. And by the way, when it comes to pricing, bigger, particularly on the agency side, over $6 million, you're 50 basis points lower. So bigger can be better. But the reality of it is, not everybody can get into a $9 million park or $9.5 million acquisition, which means you're at about a $6 million loan amount, especially for the people that are just coming into the space. So, you're going to be looking at those lower leverage deals, but just know going in, it's 30-35% skin in the game. You're going to need that to be able to buy a park.
Jeff, real quick, what are some of the other considerations from the bank's perspective when they're looking at that borrower, right? Like having the equity for the downstroke and closing costs is one thing, but how about actual liquidity requirements? What is a bank seeking, from that borrower or that sponsor's perspective?
Yeah, I mean, it's different bank to bank, but you got to figure most banks are looking at 10% post-funding liquidity. Fannie's, depending on the deal, they're 6 months to 12 months principal and interest. Some of the credit unions we're working with right now aren't too concerned about it, but 10% is a pretty good threshold. In case you do run into another situation like we have here, if coronavirus comes back and we get some more defaults, you want to make sure you've got some reserves in your account to cover some vacant units, and make sure that you don't default on your loan.
Got it.
Yeah, question for you, Jeff. This is regarding folks that already have a portfolio or at least an asset under their belt. They've been able to add some value there, got some sweat equity in the deal. Are you seeing lenders reduce their cash out proceeds on a cash out refinance, kind of given where we're at with COVID?
The answer is yes, absolutely, without a doubt. Really, unless the money is really going back into the asset, lenders aren't real keen on providing cash out. In fact, we're looking at a deal right now. It's funny you asked that because we had a deal in with one of our CMBS lenders. And they were pulling, CMBS typically is the one lending institution that doesn't have an issue with cash out. Although they're tightening up the screws on that, and a lot of them are out of the market right now. But banks, Fannie, credit unions have certainly reduced their leverage on cash out. Absolutely.
Yeah. Interesting.
Not like the good old days where you could put some sweat. This guy's got it parked for, perfect example. He's had the park for 2.5 years. He bought it for 1.6. owes 1.4, property appraised for 3.7. Lender came back and said, listen, you've only had that park for 2 years. We'll give you 20% above what you purchased the park for. So we can get them a $2 million loan. If you take 70% of 3.7, which is the appraised value, CMBS might be looking at a loan amount of $2.7 million. So he would be able to pull about $1 million of cash out after owning the park for 2 years. Not going to happen right now. He's lucky to get back, scotch over what he paid for it.
Yeah, good stuff. Well, hopefully he could weather that a little bit further until the banks get a little more clarity and then go back to the well and pull out a little bit more cash.
And I think you'll see that change as we get through this pandemic.
Yep, great stuff. Maybe, getting some Fannie debt there, even at a more modest LTV, and then pulling out a supplemental as they get more comfortable could be a solution for that guy right there. Don, this is a question for you, buddy. Is there a difference in the buyer profile who seeks West Coast properties versus East Coast assets? Thoughts?
California buyers are their own breed. That's just, I come across, two kinds of people that pretty much only want California and people that don't want anything to do with California. So I think that's kind of its own separate, but I'm seeing a lot more interest in that West Coast. Personally, I don't see the big, the reasoning for like Washington and Oregon being such low cap rates. I'm just not a fan, but though that area, Arizona is becoming, I would say, similar to California and Florida as far as pricing. So it's not really West Coast and East Coast. It's more coastal and then the, inner country, things that aren't on the ocean. Because, I've seen crazy cap rates, East Coast, just like I do, in California, but it's dependent on the location. So it's not really dividing the country kind of north and south. It's more of drawing like a little, the smile states, right? Anything that's in that coastal market is kind of their, a certain type of buyer. And then the Midwest is more of that sweat equity, kind of somebody looking to fill up some vacancies. Cause, we put out a market report that shows, if you just look at the market vacancies, it's much higher in the Midwest. If you're thinking like, rural Indiana, the price for a single family home is much lower than it is in, LA, for example. Completely different, but that's why the vacancies are higher in mobile home parks in those markets, because they can go and buy a single family house. There are certain buyers that are only looking East Coast because maybe they have 10 parks up and down that, that side of the country, and they're not really willing to spread out, all the way to the other side of the country. So it's more of, the highly sophisticated buyers that have the manpower to manage parks, nationwide. And then I think the rest of it, you can still be pretty sophisticated, but you're just not open to traveling that far. You don't want to move that far away from kind of home base. So, to answer your question, I don't really see a difference in that perspective, but just more of, whatever that investor can handle and what they're looking for.
I agree. Some of it does come down to personal preference. Speaking briefly to the cap rates and the smile states, I share the sentiment. If you kind of review the biggest players in the industry, the guys that are publicly traded, Sun Communities, ELS, UMH, and just see where their portfolio has been constructed. It's going to mimic exactly what you just outlined there, right? It's the smile states. It's UMH is in the Northeast, but the lower cap rates are going to be where the most massive institutional guys have set their footprint. And, that rising tide lifts all boats, where it's easy to be in that market and follow the market rent when they've already pushed the market rent up to $700 or whatever the location is. Some of the smaller guys can track that trend over time. And again, that rising tide will lift all boats along the way. Question for Jeff here. This is a question in regards to timing on trying to get a deal financed. with the pandemic, a lot of things have been put on pause. A lot of lenders can't get out to view the respective assets, or they might have some new protocols that they need to run through in order to go ahead and underwrite these deals. Is the timing of getting financing, has that extended? Right? I mean, when people are out there putting deals under contract, do they need to adjust their terms if they're going to go out and find a loan based on kind of how long it takes them to get a loan in the current environment?
Yeah, that's a great question. And it is taking a little bit longer to get deals done. The appraisals are backed up. Sometimes you're at the mercy of the third-party vendors. Underwriting and processing, you can streamline. Legal, you can take care of. But the third-party vendors are backed up. And I think what you used to see deals getting done in, 45 to 60 days. You're probably pushing it out to 60 to 90. So figure, 3 months to be safe. I'm not saying you still can't get it done in 45 days, as long as you can get, all your reports done on time and the lender's not too backed up. But yeah, I mean, we're doing a CMBS deal now. We just got into app. It's going to take probably 90 days. And we're doing a credit union deal that's going to take 45 days. We got an agency deal that's probably we're going to close it in 60. So it's a little bit of a moving target, but I would absolutely be more direct. I would give yourself an extra 30 days to close, just to be safe.
That's great. Great feedback. Love every bit of that. And then Don, given Jeff's feedback that, some of the financing contingencies may be a little bit longer, walk me through your experience kind of during this period of time regarding how terms have shifted, right? In terms of the buyer profile and trying to get deals under contract, are terms becoming more important? Where the money's coming from, if they're already liquid, if they got money in the bank, what can buyers do to put themselves ahead of the curve in regards to the contracts they're submitting, LOIs they're submitting, and the terms that they're requesting? Yeah,
honestly, that's a great question, because it has been very noticeable, just the difference in LOIs that have been coming in for deals. Some of them are just kind of off the wall with the due diligence period, but I would say prior to COVID, I think we were, a standard deal from what we saw was a 30-day due diligence and a 30-day close without a financing contingency. And I think now, I think that offer looks very attractive. That 30-30 is a great terms for, everything else aside. I think those are great terms for a seller to accept. But what we've been seeing is, I think a lot of people trying to get, more, and they just need it, right? They need 45, 60 days to get their loan in order, to figure out a way to travel and see the park. A lot of people aren't worried as much about the park, but they're worried about getting those third parties in on time. And they don't want to, waste someone's time, and I appreciate that as a broker, but they don't want to waste my time, and they don't want to waste the seller's time or their own with a 30-day deal if they just feel that there's no way in whatever market that property's in that they're going to get third parties, out to the site, do all their inspections, and report back in 30 days or whatever that time frame is. So yeah, I would say in general, a little bit of an extension on due diligence periods is what is maybe becoming a norm. I don't see financing contingencies. I still, I don't see like a 30, 15 or anything like that. I haven't seen that one yet. But then also to your point, you said about providing a financial statement, everybody listening, if you're new, if you put in an LOI, just put your proof of funds in there too. Just, it moves you, as far as your credibility, it gives you a couple of notches up, because if we have to go ask for it and it takes you a while, like, it's just, if you're new, we've never done a deal, just show us that you can close a deal. And that absolutely gets you taken seriously.
Yeah. Love that. On to the next question here. This is regarding RVs. What are some financing options for parks that have an RV component? I don't know. One of you guys, Jeff, you want to speak to that one first?
Yeah, we don't do a lot of parks with RVs, but we can Typically, as long as the major portion of the park is mobile homes, we can certainly get up to 25-30% RV and use that rent full for underwriting and NOI. We're starting to see more and more RV parks come our way. Capital sources for RV parks aren't as vast as they are for mobile home parks, so they're a little bit trickier. But it's out there. Pricing might be a little bit wide, certainly of mobile home park rates. LTV may be slightly lower. But I think that asset class is starting to gain some traction. And over the next couple of years, you'll probably see that asset class pick up some momentum. And I'm sure Don maybe is starting to see more of those as well.
Yeah, Don, any feedback on RVs? You got a bunch of them over in Arizona.
Yeah, I mean, we actually just put a 250 site one under contract here in Arizona. All RV, not transient in the fact, nightlies or anything like that, but transient in that they pay an annual membership and they're pretty much only out here in the winter, right? Which is, we got 8 good months out here. So it's a little different, they pay annually, but it's kind of considered transient. But the ones that we've had, I think financing is tough. If it's a really high quality RV, actual RV resort, we've been able to find lending options depending on the side of it. But I think it's, if it's I don't want to say sketchy, but if there's hair on a deal, your best bet is probably having a relationship with a bank that, either knows you or they know the market, and you've got, money to show that you can take the deal down.
Yeah, good stuff. Additional question here from Richard. He's asking about trying to pool smaller parks together within a reasonable size cluster MSA, 15 to 20 miles, to cross collateralize them for one given loan. I'll toss this to Jeff. You could speak to that. He's talking about a couple of relatively small parks here, literally a 5 and a 30 pad park, relatively small. But just generally speaking, what are banks willing to do and what are they looking for if you are proposing to put together cross-collateralized loans? Do they need to be within a specific 15, 20, MSA radius, or what are some of the characteristics associated with that cross-collateralized piece?
Yeah, thanks, Brian. I mean, if they're not contiguous, they need to be, which means they're, right next to each other. They like to see them within 20, 30 miles of one another, but not to say that you can't cross a park in different states. We're doing a deal right now where there's a park in Northern California and another park in the Midwest, and we're trying to get the loan amount over $6 million combined, and the lender's accepting that deal. So, you're states away and they're able to cross-collateralize and still keep the LTV the same and even reduce lender origination fee, which is the benefit of the deal. But you can definitely, listen, banks want to see bigger deals. The bigger the better for the banks, because it takes as much time to do a $500,000 deal, maybe more, than it does a $5 million. So if you can bring a couple of deals to the table, sweeten the deal for the lender, at the end of the day, if you can cross-collateralize a couple of properties, you're probably going to have a little better luck getting the deal financed.
Yeah, love every bit of that. And I'll put our little personal spin on this. We've had success cross-collateralizing deals across state lines as well. So I don't think it's just MSA specific. It most certainly isn't. We've had experience doing it. It's more associated with how is your relationship with that lender? Have you been able to perform with them on historical loans? And if so, they might grant you a little bit more latitude. That might be a loan that ends up not going to CMBS. It might be something that's put on the bank's balance sheet and just held there as a portfolio loan if they know, like, and trust you. But it can certainly be done. And I'll just leave it at that. So in any event, I'll just leave it at that. Guys, we're abutting the 1 hour mark. I think in the interest of everybody's time, would love to go ahead and provide you guys with an opportunity to share your information, some contact info, maybe a call to action that you would like to share with our audience. For those that would like to reach out and talk shop with you after the call, I'll pass the mic first to Jeff. How can folks reach out to you if they want to touch base afterwards?
Yeah, thanks, Brian. The name of our company is Bond Street Capital. You can reach me on the mhpstore.com. My phone number is area code 818-336-4103. It's 818-336-4103. Email is jmoss@bondstreetcc.com. And, I think at the end of the day, Brian, for borrowers out there that are looking to get help financing, we'll size the deals up for you. We'll take you from start to finish. We stay involved from the day we talk about the deal, we underwrite it in-house, and we ultimately try to find the best solution for the borrower. We talk to them about what their needs are, and then their expectations have to be real, because we do get a lot of borrowers that come to us and don't have real expectations, and we can kind of dial them in, custom tailor a loan for them, because not everybody wants to be in a 10-year deal fixed for 10 years with yield maintenance. You may have a value add deal that's 100 pads, 60 occupied. You're going to fill it up, and 3 years from now, you're going to want to pull some cash out, which we see a lot of. So you don't want to be locked into that yield maintenance prepay. You want to have the flexibility of a step-down prepay or no prepay at all. And we're starting to see a lot more credit union deals now because there's no prepay associated with credit union deal. But jmoss@bondstreetcc.com. And love to hear from you. Call me anytime with any kind of question at all. No deal is too small or big.
All right, Jeff. Love that, buddy. You got one of those easy names, right? Jeff Moss. Easy peasy, lemon squeezy. I love that. Don, I'll pass the mic to you, but how can folks reach out?
I was literally just going to say that about your name, Jeff, because all the letters in my last name rhyme. So if I add up all my sales career, how long I've spent phonetically spelling out my last name, it's probably a pretty long time. But Northmarq, we've got a pretty unique situation. We've got the national MHC specific brokerage, and we also have that direct lending platform within Northmarq. So I think it's unique in that when we do list a property, we can have debt options already lined up, which helps buyers right off the bat. But a couple things about us, we do put out a lot of information. I mentioned that in the beginning. Every month we do a sales report where we gather as much data we can from all the resources that we have available, and show every MHC that we can track and what it's sold for. So we send that out. If you're on our distribution list, every quarter we do just manufactured housing industry report with information about home shipments, vacancy, cap rate, price per site. We just sent that out yesterday, I believe. And then also, if you own a park and you're just interested in getting a broker's opinion of value, always happy to help. I know you got other relationships, or you may or may not. Happy to provide our opinion and just give you that kind of second set of eyes looking at it. But you can reach me if you want to get on our distribution list. Everything. My cell phone is 847-826-0258. And then my email is dvedeen@Northmarq. So that's D, V like Victor, E like Echo, D like Delta, double E, N like November @Northmarq.com. And Northmarq has a Q.
Love that, man. So we went with the military version. I love every bit of that, man.
Yeah.
I have that shaved head. People always ask me if I'm in the military. Answer is no. Got some family. That is there.
You're just a tough guy. That's all, Brian.
I think I am, but I'm really not. In any event, also, guys, we're going to put in the show notes the rate chart that Jeff discussed and we walked through a little bit earlier, and we'll also put in the show notes the market report from the first quarter that Don just referenced that was just released. So we'll put that there for you guys to check out if you have an interest. But that's it for today. It's been a lot of fun, guys. I really appreciate both Jeff and Don joining us today. It's been great. But that's it for today's show. And with that, until next time, you guys be great.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.